right, everyone. Thanks for tuning in to the Property Wealth Podcast. Today, we're diving into a fascinating topic that's really shaping the future of real estate, data centers, and how they're becoming this AI-driven play for 2026.
Yeah, it's pretty exciting stuff, Sarah. The way technology is evolving, it's opening up new avenues for investors, especially for those of us looking to build long-term wealth.
Exactly. So we'll be discussing what data centers are, why they're gaining traction, and how they fit into your investment strategy.
Right, and we'll also touch on the potential risks and what you should consider before diving in.
Plus, we'll share some practical advice on how to get started, even if you're new to this space.
And, it's important to understand the fundamentals, so we'll break it down in a way that's relatable and easy to grasp.
Absolutely. So whether you're thinking about diversifying your portfolio or just curious about the future of real estate, you're in the right place.
And I think it's worth noting, Sarah, that these tech-driven investments are not just for tech-savvy folks. They can be accessible for everyone.
Yes, that's a great point. So let's jump right into it. What exactly are data centers, Mike?
So, Sarah, when we talk about data centers and how they fit into this whole real estate investing landscape, it's really important to consider why this matters, especially for folks over 40.
Absolutely, Mike. Retirement timelines are shifting, and many people are looking for ways to secure their financial future.
Right. A lot of investors in their 40s and 50s are starting to think seriously about how to build a nest egg that will last them through retirement.
Yeah, and let's not forget the rising cost of living and inflation. It can really eat away at savings if you're not careful.
Exactly. Investing in data centers can provide that crucial hedge against inflation. Because, as more businesses transition to cloud computing and digital services, the demand for data storage is only going to increase.
Right. And it's not just about the demand. It's about the consistency of that demand. Businesses need these services regardless of market conditions, which makes it a pretty stable investment.
Totally. I've spoken to a few investors who have integrated data centers into their portfolios. One guy, let's call him Mark, he's in his early 50s. He started looking into data centers about a year ago after noticing how much his expenses were increasing.
What did he find?
Well, Mark realized that traditional rental properties weren't giving him the returns he needed to keep up with inflation. He wanted something that could not only provide cash flow, but also appreciate over time. So he made the leap into data centers.
That's a big step. How's that working out for him?
So far, really well. He's already seeing a solid return. He mentioned to me that it's comforting to know that his investment is kind of future-proof, With digital services on the rise, he feels like he's on the cutting edge.
That makes total sense. And for those looking to pass wealth down to their families, it's a smart strategy, right?
Definitely. Wealth transfer is a big consideration for many people. Investing in something like data centers can be a way to create a lasting legacy for your kids or grandkids.
Yeah. Think about it. If you can set them up with a solid investment that continues to grow, you're giving them a leg up that many people don't have.
Exactly. And let's not forget the emotional side of financial security. Many people over 40 are starting to feel that pressure, wanting to secure not only their future, but also their family's future.
Right. It's not just about the numbers. It's about peace of mind, too.
Yes. I've had conversations with investors who say they sleep better at night knowing their money is working for them in a stable, growing sector.
It's interesting how much that emotional aspect gets overlooked. People often focus on the technical side of investing. But forget that. At the end of the day, it's about feeling secure.
Absolutely. And with the current economic trends, we're seeing shifts in how people work and communicate. The pandemic really accelerated digital transformation, and that's not going away.
So true. Many companies are now choosing to operate remotely or in hybrid models, which means they need more data storage and processing power.
Right, and that creates a huge opportunity for investors who are looking to get involved in data centers. It's like being on the front lines of a massive change in the economy.
I can see how that could be appealing for someone who's, let's say, a bit apprehensive about traditional real estate markets.
Exactly. Traditional markets have their ups and downs, but data centers offer a different kind of stability.
And for someone who's nearing retirement, that sense of stability is key.
Yeah, investors need to be thinking ahead about how to protect their wealth. The last thing you want is to be scrambling to make ends meet in retirement, because your investments didn't pan out.
And it's not just about protecting wealth, it's about growing it strategically.
Right. I've also seen investors diversify into data centers alongside their existing portfolios. They're looking for that balance.
That's a smart approach. It allows them to mitigate risks while still participating in a growing sector.
For sure. And I think it's important to highlight that this isn't just an investment strategy for the tech-savvy. Many people can get involved with the right guidance and resources.
Exactly. You don't have to be a tech wizard to see the potential here.
And, for those listeners who might be thinking, this all sounds great, but how do I actually get started?
That's the big question, isn't it?
Yes, and I think it's crucial to look at it as a long-term strategy.
Right. Understanding the market, doing your research, and maybe even partnering with someone who has experience in the field can make all the difference.
Absolutely. So as we transition into some core strategies for getting involved in data centers, it's important to remember that this is a journey.
Yes, and one that can lead to not only financial security, but also peace of mind for you and your family.
So let's dive into some core strategies and rules of thumb when it comes to investing in data centers. It's a bit different from traditional real estate, but there are still some solid principles we can follow.
Absolutely, Mike. I think one of the first things we should touch on is the 1% rule, right? It's a classic guideline in real estate.
Right. The 1% rule suggests that the monthly rent should ideally be at least 1% of the purchase price. So if you're looking at a data center that costs $1 million, you want to aim for at least $10,000 a month in rent.
That makes sense. But in this case, how do we apply that to data centers? The rental income might not be as straightforward as with residential properties.
Exactly. Data centers often have longer lease terms, and the income can come from multiple tenants or co-location services. So it's essential to analyze the potential revenue streams carefully. Look at the total square footage, the types of tenants, and their creditworthiness.
Speaking of tenants, what's a good rule of thumb for evaluating them?
A smart approach is to assess the tenant's financial stability. A common metric is the debt service coverage ratio, or DSCR. Ideally, you want it to be above 1.25. This means the tenant should be generating at least 1.25 times the cash flow needed to cover their debt obligations.
Got it. And that's crucial because, unlike residential tenants, if a data center tenant defaults, it can take longer to find a replacement.
Exactly. And, another critical factor is location. The 50% rule can be handy here. It suggests that for every dollar you spend on the property, you should expect to spend about 50 cents on operating expenses, maintenance, and other costs.
Right, so if you're looking at a $2 million data center, you should budget around $1 million for those ongoing expenses?
Yes, that's a good starting point. But with data centers, you also have to consider the specific tech needs, like cooling systems, backup power, and security measures. These can add to your expenses significantly.
And that brings us to cap rates, which are essential for evaluating the value of commercial properties, including data centers. What's a good cap rate to aim for?
Generally, a cap rate between 6% to 10% is a reasonable target for data centers, depending on the market and the property's specifics. A lower cap rate usually indicates a higher quality asset, while a higher cap rate might suggest more risk.
So, if you buy a data center for $1 million and it generates $70,000 a year in net operating income, that gives you a cap rate of 7%, which is pretty solid.
Exactly. And, when evaluating deals, it's essential to have a checklist. Start by assessing the property's location, tenant mix, and lease terms. Then, look at the financials, operating expenses, potential income, and historical performance.
That's a comprehensive approach. You mentioned financing options earlier. What are some good strategies for financing a data center investment?
Well, conventional loans are an option, but given the unique nature of data centers, you might also consider specialized lenders who understand the tech space. There are also opportunities for investors to partner with tech firms or even other real estate investors to share the risk and capital.
And I imagine having a solid business plan is crucial for attracting those partners or lenders?
Absolutely. A detailed business plan should outline your strategy, market analysis, estimated costs, and projected income. It's your roadmap and helps instill confidence in your investors or lenders.
That makes sense. Now, what about property types? Are there specific types of data centers that are more favorable for investment?
Good question. Generally, there are three types: enterprise data centers, colocation centers, and wholesale data centers. Each has its pros and cons. For instance, colocation centers tend to have multiple tenants, which can provide more stable income, while enterprise centers might be riskier because they often rely on a single tenant.
So co-location centers might be the safer bet for someone just starting out, right?
Exactly. They can offer diversification, which is crucial for managing risk, and you also want to keep an eye on emerging markets. Areas with growing tech industries often have high demand for data centers.
It sounds like there's a lot to consider when diving into this space, but it's definitely promising.
For sure. But as with any investment, you have to be cautious. It's easy to get swept up in the excitement of tech trends. You need to do your due diligence.
So what are some common pitfalls to watch out for in data center investments?
Well, one big one is underestimating operational costs. As we mentioned, tech infrastructure can be expensive. Another is overlooking the importance of tenant diversification. Relying too heavily on one tenant can be risky.
And I guess market volatility could pose a problem as well, especially with how quickly technology can change.
Exactly. Keeping up with technological advancements and ensuring your data center is equipped to handle future demands is crucial. You don't want to invest in something that might become obsolete quickly.
Wow, that's a lot of valuable info, Mike. It sounds like data centers can be a great investment, but with careful planning and execution.
Definitely, Sarah. With the right approach, they can be a solid addition to a diversified portfolio, but always keep your eyes open for potential challenges. You know, Sarah, when it comes to investing in data centers, one of the biggest pitfalls I've seen is over-leveraging.
Right, that makes sense. It's like you're so excited about the potential, you take on more debt than you can handle.
Exactly. I had a client once who jumped into a data center investment with both feet, financing almost 90% of the purchase price. He thought, this is going to be a gold mine. But then, when the market shifted,
Oh no, what happened?
well, he found himself struggling to meet the mortgage payments. Cash flow was tight because he hadn't factored in the operational costs, and he was relying too much on future growth projections that didn't pan out.
So what did he do?
He ended up having to sell the property at a loss. The lesson here is to really assess your leverage. It's crucial to maintain a balance between using debt to build wealth and ensuring you can manage that debt comfortably.
Yeah, that's a tough lesson. I imagine bad tenants can also be a significant issue, right?
Absolutely. I've seen investors who were so eager to fill their data centers that they overlooked tenant quality. One investor I worked with jumped at the chance to lease to a startup without doing proper due diligence.
Oh, that sounds risky.
It was. The startup defaulted on their lease just 6 months in, leaving him with a vacant space and no income. It took months to find a reliable tenant, and in the meantime, he was still responsible for the property's expenses.
Yikes! So what's the takeaway there?
Always vet your tenants thoroughly. Look for established businesses with a solid track record and financial stability. Don't just fill the space. Fill it wisely.
That's really important. And I guess ignoring cash flow is another common mistake?
Definitely. I had another client who focused solely on the potential appreciation of the asset, but didn't pay attention to the cash flow. He was convinced that in a few years, the property value would skyrocket, but the cash flow was negative from day one.
That must have been frustrating.
It was. He had to dip into his personal savings to cover the losses, which wasn't part of the plan at all. You can't ignore cash flow. It's the lifeblood of any investment.
So what should investors do to avoid that pitfall?
Keep a close eye on your cash flow projections and ensure they align with your expenses. Be realistic. If the numbers don't add up, it's a red flag.
Speaking of red flags, I've heard a lot about timing the market. Is that a mistake you see often?
Oh, for sure. Timing the market is like trying to catch a falling knife. One investor I know thought he could perfectly time the purchase of a data center. He waited for what he believed was the ideal moment, but the market kept climbing.
And then?
By the time he finally bought in, the price was way higher than when he first started researching. He missed out on a better deal because he was too focused on timing, rather than just getting in and making it work.
So it's better to focus on long-term trends instead of trying to time the peaks and valleys?
Exactly. Real estate is a long game. If you find a solid investment that meets your criteria, don't wait for the perfect moment.
That's such a helpful perspective. And I imagine hidden costs can sneak up on you too.
Absolutely. I had a colleague who bought a data center thinking he had accounted for all the expenses. But once he closed the deal, he discovered significant maintenance issues that had been overlooked, which cost him thousands right off the bat.
That must have been a real shock.
It was. The hidden costs can really affect your bottom line. Always conduct thorough inspections and factor in potential repairs when you're calculating your budget.
So what do you suggest for spotting those red flags early?
Well, start with due diligence, ask lots of questions, review financials, and don't shy away from getting a third-party inspection. If something feels off, trust your instincts and dig deeper.
Those are great tips. It sounds like being proactive can save you a lot of headaches later on.
Exactly. And if you do find yourself in a tough spot, there are ways to recover. If you've over-leveraged, consider refinancing or selling off a portion of the investment to reduce your debt load.
That's a smart approach. And for bad tenants, I assume having a good property management team can make a huge difference.
Absolutely. A good management team can help screen tenants and handle issues, so you don't have to. And remember, you can always renegotiate leases if a tenant isn't performing as hoped.
I love that. Always have a plan B. And for those who might overlook cash flow, it sounds like regular financial reviews would be key.
Definitely. Monthly reviews of your financials can help catch issues before they become major problems. And if you find you're consistently in the red, it might be time to reevaluate your investment strategy.
So much valuable insight, Mike. It's clear that staying informed and being proactive can really help avoid these common pitfalls.
That's right. The goal is to build sustainable wealth over time, and learning from these experiences can help you navigate the real estate landscape more effectively.
I think that's a perfect note to end on. Thanks for sharing all these insights, Mike. It's been a real eye-opener.
My pleasure, Sarah. Happy investing, everyone. So now that we've delved into the potential of data centers, it's time to get into some actionable steps, right?
Absolutely. I think a lot of people are eager to know what they can do to start exploring this avenue.
Yeah, so first things first, if you're brand new to this, I'd suggest starting with some research. I mean, you can't go wrong with diving into resources like Zillow or even local MLS Access. They offer tons of data on real estate trends and pricing.
Right, and speaking of data, have you heard of Rentometer? It's a great tool for analyzing rental prices in specific areas. It can really help you gauge the market rates, especially if you're looking at properties near data centers.
Exactly. And don't forget about the BiggerPockets calculator. It's a fantastic tool for analyzing potential deals. You can input your numbers and see how they stack up before you make any commitments.
That's a game changer for sure. And, when you're analyzing deals, I'd recommend starting small, like aim to evaluate one deal per week. It keeps the learning curve manageable, and you won't feel overwhelmed.
Yes! And also consider joining local real estate meetups. They're great for networking and connecting with like-minded people. Plus, you get to hear firsthand experiences, which can be invaluable.
Oh, for sure. Networking can open up so many doors, and if you can't find a meetup nearby, there are plenty of online communities too. Platforms like BiggerPockets have forums where you can ask questions and share insights.
That's a good point. Engaging with online communities can be just as beneficial, especially if you feel a bit shy about going to in-person events.
Absolutely. And let's not forget about books. I'd recommend checking out The Book on Rental Property Investing by Brandon Turner. It offers a solid foundation and touches on a lot of strategies you can implement.
And if you're into podcasts, there are some great ones out there too. BiggerPockets podcast, for example, has interviews with real estate investors who share their journeys. It's inspiring and packed with practical advice.
Great suggestion. And I think it's also important to create a habit of continuous learning. Maybe set aside just 30 minutes a week to read or listen to something new about real estate investing.
Yeah, consistency is key. You don't have to dedicate hours every day, but small, regular chunks of time can really add up over weeks and months.
For sure. And when you're ready to dive deeper into data centers specifically, consider researching companies that operate in that space. Understanding their business models can give you insight into potential investment strategies.
That's a smart move. Also, looking into local economic reports can be beneficial. They often highlight trends affecting industries, including tech and data centers.
Yep, and keeping an eye on government policies regarding data centers is crucial too. sometimes tax incentives or zoning changes can really impact the market.
Right, it's all about staying informed. And if you can, consider reaching out to local real estate professionals who have experience with data centers. They can provide you with insights that you might not find in a book or online.
That's a great idea. Plus, building those relationships can lead to mentorship opportunities, which can be incredibly valuable.
Definitely. And don't forget to track your progress. Maybe start a journal where you note down your findings, thoughts, and any deals you come across. It's a good way to reflect on your journey and stay motivated.
That's such a practical tip. It helps keep you accountable, too. And remind yourself that it's okay to start where you are. Every investor was once a beginner.
Exactly. It's all about taking those small steps. And, as you gain confidence, you can start exploring larger deals and potentially even partnerships.
Right, and with technology advancing so quickly, you might even find opportunities that weren't available a few years ago.
Yeah, the landscape is changing, and it's exciting. With these tools in your pocket, you're ready to move forward. Let's recap what we've covered today. All right, so as we wrap up, let's just quickly recap some of the key takeaways from our discussion on data centers and their potential in the real estate market for 2026.
Absolutely, Mike. I think one of the biggest points is the growing demand for data centers, driven by AI and tech advancements. It's fascinating how much data we generate every day, right?
Exactly. And that leads us to the second takeaway, the stability of cash flows from these properties. Unlike traditional rentals, data centers often have long-term leases, which can provide a steady income stream.
Right, and let's not forget the third point about location. The importance of strategic placement near urban areas or tech hubs can really make or break an investment in data centers.
Yeah, and we also touched on the technological advancements that can enhance efficiency and ultimately profitability. It's a game changer for real estate investing.
So whether you're just starting out or looking to diversify your portfolio, data centers could be an avenue worth exploring.
Absolutely. And remember, building wealth through real estate isn't just about making quick profits. It's about creating a sustainable future for yourself and your family.
Yeah, and if you found today's episode helpful, we'd love for you to like, subscribe, and maybe even drop a comment with your biggest takeaway or a question you might have.
And don't forget to share this with someone over 40 who's looking to invest in property. It could really make a difference for them.
Next time, we'll dive into build-to-rent communities. Really exciting trend analysis coming your way.
It's going to be a great discussion, so tune in for that.
Thanks so much for joining us today. We really appreciate you spending your time with us.
Take care, everyone.
Bye for now.